Welcome to Charged Alpha's Q2 FY2026 earnings coverage. Today we're covering D.R. Horton, ticker DHI, America's largest home builder by volume, which just beat earnings estimates by 4% while closing 19,486 homes in a single quarter.
19,000 homes in one quarter. And the stock jumped 7% on the news, which tells you the market was bracing for something worse.
The context matters here. Mortgage rates are still above 7%, home prices are still high, and yet DHI is closing homes at a clip that no other builder in the world can match. That's the franchise.
The question we're going to answer today is whether the execution is good enough to justify a 15 times earnings multiple, or whether revenue miss is the beginning of a harder story.
D.R. Horton was founded in November 1978 by Donald R. Horton in Fort Worth, Texas, with $500,000 in borrowed capital and a simple idea: sell the house while you're framing it, not after you finish it.
That model, pre-selling to reduce inventory risk, is still central to how DHI operates. Today, the company builds in 31 states and 98 markets under 4 brands. D.R. Horton for the core buyer, Express Homes for the entry-level buyer, Emerald Homes for the move-up luxury buyer, Freedom Homes for active adults.
It's a clever market structure. When rates go up and move-up buyers freeze, DHI leans into Express. When rates come down and premium demand returns, Emerald captures that buyer. One company, 4 price points, full cycle coverage.
And the business is bigger than just homes. DHI also runs DHI Mortgage for financing and DHI Title for insurance and closing services. Full vertical integration means they capture fees at every step of the transaction.
The numbers are enormous. Full year FY 2025 was $34.3 billion in revenue across 90,000 closings. The land bank, the inventory of lots and homes under construction, stands at $25.6 billion.
That land bank is both the moat and the risk. Scale buys you the best land prices, the best labor contracts, and the best material pricing. But $25 billion in inventory becomes a liability if housing prices drop or buyers disappear.
The company has roughly 15,000 employees. It's the full-scale version of what Donald Horton built with $500,000 in 1978. Leading the company is Paul J. Romanowski, who became president and CEO in October 2023 after more than 2 decades at DHI.
Romanowski started at D.R. Horton in 1999 as a division president in South Florida, not a back-office role. High volume, high pressure, close homes now territory. He rose to regional president overseeing Florida and multiple mid-Atlantic states, then was named co-chief operating officer in 2021.
When David Auld retired as CEO in 2023, Romanowski wasn't a surprise pick. He was the obvious choice, someone who'd built his entire career inside the operational machine.
Wall Street views Romanowski as an operator, not a strategist. In home building, that's a compliment. The formula works. His job is to execute it at scale. His first full fiscal year as CEO, FY 2025, produced $34 billion in revenue and record closings above 90,000 homes.
Let's get into the financials. Lana, what's the Q2 FY 2026 headline?
Mixed result, but the market read it as a beat. Revenue of $7.56 billion came in against a $7.66 billion estimate, a miss of about 1.3%. But EPS of $2.24 beat the $2.15 consensus by 4.2%. Net income was $648 million.
Why is EPS more important than revenue for a home builder?
Because the revenue miss was driven by volume timing and average selling price, not a collapse in demand. 19,486 homes closed is a big quarter. The average selling price of roughly $359,000 is down from $373,000 a year ago. That ASP decline compresses the revenue line. EPS held because cost controls and share buybacks supported the bottom line.
How does Q2 FY 2026 compare to a year ago?
Revenue of $7.56 billion is down 2.3% from $7.3 billion in Q2 FY 2025. EPS of $2.24 is down from $2.58 a year ago. Both metrics are declining year over year. The sequential bounce, up from 192 EPS and 6.9 billion revenue in Q1, shows the spring selling season doing its job, but the year-over-year comparisons are working against the bulls.
What about full-year guidance?
Management maintained full-year FY2026 guidance at 86,000 to 88,000 homes and 33.5 to 34.5 billion in revenue. That maintained guidance is what drove the 7% stock pop. The market had quietly priced in a guidance cut.
Let's talk valuation. How expensive is DHI right now?
At 164.31 after the 7% move, DHI trades at about 15.4 times trailing earnings. Price to book is 2 times, price to sales is 1.43. The Graham number, Benjamin Graham's classic intrinsic value estimate, works out to about $142. So the stock is trading about 16% above that intrinsic value floor.
How does the balance sheet look?
Cash of $2.5 billion against long-term debt of $5.5 billion gives you net debt of roughly $3 billion. Total assets are $34.6 billion. Total equity is $24.6 billion. Debt to equity is about 23%, conservative for a home builder at this scale.
And inventory, that's the big number for home builders.
Inventory of $25.6 billion is the core operating asset. That's lots and homes across dozens of markets, representing 2+ years of supply at current volume. It's what makes DHI's scale sustainable. It's also what gets impaired if housing prices fall.
Cash generation?
Q1 FY2026, the December quarter, generated $854 million in operating cash flow and $827 million in free cash flow. That's strong. Q2 for home builders tends to be negative on OCF because spring is when you're building inventory ahead of summer deliveries. Full-year free cash flow is back-half weighted. On capital returns, DHI is spending $2.5 billion on share buybacks in FY2026, over 5% of market cap, and paying a quarterly dividend of 45 cents per share, or $1.80 annualized. That's a 1.1% yield at today's price. Overall, D.R. Horton's financial health is solid. The EPS beat and maintained guidance are genuine positives. The declining average selling price and modest revenue miss are real headwinds, but the operating machine is intact.
How is Wall Street positioned on DHI?
The consensus is hold, which is notable given how often the largest home builder gets benefit of the doubt. Of 19 analysts covering the stock, 7 have buy ratings, 9 have hold, and 3 have sells. The average price target is $154, $10 below where the stock is trading today after the earnings pop.
So the stock is trading above consensus price target. That's unusual.
It means the market is pricing in a scenario the median analyst hasn't captured yet, either faster rate normalization or a stronger than expected spring selling season. Whether analysts raise their targets this week will tell you a lot about street conviction.
What are the notable calls?
Argus Research has the highest target at 185, a buy rating built on the long-term housing shortage thesis. UBS also maintains buy at 180. On the cautious end, Truist maintained hold and cut its price target to 140 post-earnings. JP Morgan is at underweight, RBC at underperform, both bear case holders on affordability and margin concerns.
Any recent moves?
Seaport Global downgraded from buy to neutral in early April. Wells Fargo downgraded from overweight to equal weight in January. Those moves, combined with the Truist target cut today, tell you the street is skeptical that DHI can sustain margins through a prolonged high-rate environment.
Let me build the bull case. D.R. Horton is the largest home builder in America by volume, and scale in home building is a compounding advantage. Better land prices, lower material costs through bulk purchasing, cheaper labor contracts. Every cycle, the gap between DHI and smaller builders grows. The multi-brand strategy is genuinely well-designed. When rates are high and affordability is squeezed, DHI redirects to Express Homes, entry-level product that reaches buyers competitors can't touch. When rates normalize, Emerald captures the move-up buyer. The company has structured itself to win across the cycle, not just in a benign environment. And the capital return program is real. $2.5 billion in buybacks this fiscal year, a $1.80 annual dividend, guidance maintained, Management doesn't hold guidance into a weak second half unless they can see the demand pipeline.
The bear case comes down to 3 words: selling price compression. Average selling prices are down year over year. That means DHI is deploying more incentives, mortgage rate buy-downs, appliance packages, closing cost assistance, to move homes. Incentives are margin compression in disguise. If gross margins fall below 19%, earnings estimates reset lower, and 15 times earnings looks expensive. The 30-year fixed rate above 7% is the core structural risk. Every basis point of rate is a buyer at the margin who can't qualify. DHI can write down the effective rate through DHI mortgage buy-down programs, but that has a cost. If rates stay elevated through the back half of FY2026, the 87,000 home guidance becomes very tight. And multiple analyst downgrades in early 2026, Seaport, Wells Fargo, JP Morgan, aren't noise. They're an informed view that the margin story has turned. With the stock now trading above consensus price target, the risk-reward at today's price is skewed toward disappointment, not upside.
How does DHI compare to the other big home builders?
3 direct comparisons. Lennar is the number 2 builder and DHI's most direct peer. Lennar trades at 14 times earnings, a meaningful discount to DHI, and its price to sales is about 1.2 versus DHI's 1.43. Revenue at Lennar was down almost 6% last quarter, worse than DHI's decline. Len is cheaper, but coming off a tougher quarter.
What about Pulte Group?
Pulte is the most interesting valuation case in the group. PHM trades at 11.6 times earnings, the cheapest of any large home builder. Price to sales at 1.3. Revenue growth actually positive at about 2%. Pulte's focus on move-up and active adult buyers gives different cycle exposure, and the valuation case is arguably more compelling than DHI at current prices.
And NVR is the premium outlier.
NVR trades at 16 times earnings and 2.8 times sales, significantly above the group. But NVR uses an asset-light lot option model rather than owning land, which dramatically reduces inventory risk. That capital efficiency justifies a premium, especially when rate risk is elevated. DHI doesn't have the same risk management profile, but it has far more scale.
So DHI is the scale leader, the franchise player, but not the cheapest valuation.
Exactly. If you want the safest balance sheet in home building, NVR. If you want the most volume and the clearest full-cycle coverage, DHI. If you want the best valuation, PHM at 11.5 times makes the arithmetic more attractive.
What is the options market telling us heading into and out of today?
The put-to-call ratio was 2.2 heading into this morning, more than double the puts relative to calls. That tells you institutional players were heavily hedged, expecting a potential miss or guidance cut. With a 4% EPS beat and maintained guidance, those puts are burning today.
What was implied volatility like?
Running at the 72nd percentile of DHI's one-year range, elevated but not panic level. Post-earnings, that IV should compress quickly as the uncertainty resolves. The interesting pre-earnings positioning was in April expiry calls at the 170 and 180 strikes, suggesting some traders were set up for exactly this kind of move. For anyone watching the options market, the practical takeaway is that the event risk has resolved. The next volatility catalyst is Q3 earnings in July, and specifically whether gross margins are holding.
What's the insider picture?
Routine activity. Michael Murray, the Executive Vice President and Chief Operating Officer, sold 120 shares in February. Aaron Odom, the SVP and Controller, sold 260 shares around the same time. Both were tied to RSU vesting tax withholding, not open market conviction sales.
No alarm bells.
No, the absence of open market buying is always worth noting. Management isn't adding to positions at these prices. But the selling pattern is the standard executive compensation life cycle, not executives running for the exits. Worth watching if larger non-RSU-related sales appear in post-earnings filings.
What are the key risks and forward watch points?
5 factors. First, mortgage rate trajectory. A sustained 7% plus 30-year rate is not the bull case environment. Every month rates stay elevated, a segment of potential buyers delays or qualifies for less. Second, gross margin. The home sales gross margin is approximately 22% in Q2, down from a peak above 25%. DHI's own prior guidance was 19 to 19.5 for this quarter. Delivery above that is good, but if we see margins break below 20 in Q3, the conversation shifts to how much earnings power has structurally declined.
Third,
Net orders and cancellation rate, 18% cancellations in Q1, was manageable. In a rising rate environment, that number can spike fast. Watch for cancellations above 25% in Q3 as an early demand deterioration signal. Fourth, land bank exposure. $25.6 billion in inventory locks in significant capital. Any meaningful national home price decline triggers an impairment conversation that would reprice the stock sharply. Fifth, the stock is now above consensus price target. The market has priced in execution. Any guidance reduction in Q3 or Q4 would be a catalyst for meaningful downside. The 7% pop today has reset the bar higher.
let's bring it all together.
D.R. Horton delivered a solid Q2 FY2026 result. EPS of $2.24 beat estimates by 4%. $648 million in net income. Full-year guidance maintained at 86 to 88,000 homes. The scale advantages are real, the multi-brand model is working, and the balance sheet is conservative at 23% debt to equity.
The tension being the revenue miss and ASP decline.
Both are real. Revenue missed by 1.3% and is down 2.3% year over year. Average selling prices are declining as incentive costs rise. The core question heading into Q3 is whether the summer selling season can restore volume without further margin sacrifice. If gross margins hold above 21% and net orders stay positive, the bull thesis holds. If margins crack below 19% and cancellations tick up, the story changes significantly.
The one metric to watch.
Home sales gross margin. DHI delivered above the 19 to 19.5% guidance floor in Q2. If summer pricing power returns and gross margins expand back toward 23%, the stock earns its premium. If incentives stay elevated and margins stay compressed at 20%, 17 times earnings becomes very difficult to justify.
We'll leave you with this, from Paul Romanowski. We build homes for people who want value. That's not a strategy that changes with interest rates.
25 years in the business, and the answer to affordability is still the same. More homes, better priced, faster built. That's the DHI model, and with 87,000 homes targeted this fiscal year, they're not letting up.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. And if this D.R. Horton deep dive helped you understand how America's largest home builder actually works, that's exactly what we're here for. Subscribe, and you won't miss the next one. That's going to do it for our Q2 FY2026 earnings deep dive here on Charged Alpha. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.